Hello everyone, I'm back with another video. Wow, 3 videos in a week. We're getting consistent, folks. Well, what do we got here? Well, we got some volatility in the market, that's for sure. A little bit of volatility, some things more than others. And I guess I can go over the portfolio quickly. I made some changes. Remember, risk management, folks. That's what we do. So, NTNX, haven't done anything. That percentage is wrong. Sell, haven't done anything. That percentage is wrong. All the percentages are wrong. Wix, haven't done anything. And then I got some tail risk trades. Tail risk. Yes, ladies and gentlemen, tail risk. And I'll go over those in a second, but those are new trades. I did get rid of MU. It's probably the sell right here. Yes, so I cut MU quickly. I mean, it's obviously a loss, but I cut MU quickly. The price action was just terrible. And especially like we started seeing, IBM get whacked. I think we're starting to see a lot of the big high flyers get whacked. And I don't know if that's the end of their trade. My bet is that this is going to cause some volatility. And up here would probably be another buy zone for those names. But too early to tell. We don't know, right? It's similar to nature of like how certain names do something like this, where they get this big base on a volatility move, and then they have another leg up, right? Even Nebius getting hit. So a lot of those names are unwinding, and obviously I did get some tells here. So UNH 650 call for 675. All of these are on the charts here. But I wanted to talk about a few things. First, I guess I can talk about the tails and the back tester. Well, the back tester is new and improved, and it's improving every day. And right now, the portfolios are now by eras, or basically dates, basically. So flat 500 is just all dates, and then you could run it through specific dates to see how that portfolio would respond in that era to see if it survives. Because if you look down here, 1700 signals, unmarketable. So there's a lot of things like that could be skipped. So 6 skipped there, 26 there. So what this allows you to do is just make sure that those years that you pick something up don't ruin the portfolio, right? Now these ones have some pretty crazy drawdowns on here, but the compounding growth rate on tails works really well. 2022 is probably the worst year for the tail trade. Yeah, it is. 2022 is the worst. And it makes sense. 2022 was a down year. Kind of like a bear market. And almost a bear market. And so what this effectively does, it's the curated one here, the tail trade. I don't know if you know this now. Your screeners are now here. And what you can do is when you load a screener, you can click save and then get an email every day of what tickers come up new in your screeners and what tickers go out of the screener in the last days or so. So that's new, and it moved there. And so the curated ones are still here. And I'll just run these. And so there's a lot here. And I've been trying to back test what really triggers this type of idea. And there isn't anything that really puts it down. A really bad thing is if you take the realized vol 365. Also, there's this new metric thing where you can take a specific metric and compare it against another metric that of similar type, right? So I know one that does bad. It is the realized vol 365. So it goes back 252 trading days and calculates the realized vol. But it's over the history. It's like over 13 years, right? So it's kind of, it's really accurate. Anyway. Also, there's P10 and P50 and P90 for all the curve anchors and all the realized vols. What that means is like, let me go over here. Let's pull one up that makes sense. Maybe UNH. Yeah. So I could see the P10 to P90 realized vol. It's the little pink purplish one there. So 18.1% annualized to 47.8% annualized. And currently it's sitting at 40.4. And the median is 23. Now that's the skew, right? So that's very important. And so that's something like online. Well, I don't have to draw it. I could just show you. Median distribution. So I don't have to draw it. Here we go. So if you look at the distribution and where the median lines up, where's the one that's skewed? Give me one that's skewed. Here? Yes. So median, mean, and mode, right? And so you could tell that if the median is next to the mode, you got a big fat tail, right? Now, on the normal distribution, they're all the same. See? So we go here. Here's the median of the set, right? Here's the middle of the set. And then you have some standard deviations sitting there. So this is the median. And you could see that realized vol is way above that in volatility terms, right? And you want volatility to make money. And what this does specifically is it takes the bottom 20th percentile where the realized vol in the last year is elevated. So you think about the whole universe of equities and think about the realized vol. So that's the volatility over the year. And then what you do is you take the lowest ones of that, and that's what you trade. So it's basically things that have had a lot of volatility, but the options are underpricing it. That's what this does. And the underpricing is important because I think one of these shows it. Let me see here. Yeah. So look, if I go, well, the metrics aren't here. That like, it doesn't tell me like what deltas I picked, so that's a thing. But if I duplicate, I could see it. So look, by a single call at the strike nearest to 10 delta, over 250, pick the longest one at mid, contract size, whatever, right? Now a 10 delta, theoretically, if you take the normal distribution, is the sum from left to right. And so it's 10% probability. That's what that means. So this delta is a 10% probability, but there's a 21% win rate. How can that be? Right? So it's underpricing expected volatility. That's what that means. And because it's under expecting it in the future, that's where you get all the returns because they're underpricing volatility, right? And then you get some names in here like this. You can see it's like maybe holding for a year or two. Look at that. Crazy move. It picked up Google. There's some drawdowns on these names. Some really big returns here. Look at these P&Ls. And this one has a yearly reset, meaning that, let's say I do 0.5% of the portfolio to start, $500, but at the end of the year, I then do that calculation again, and that's my new starting point. So as the portfolio increases its value, your flat percentage also increases. And that's how you get the compound annual growth, right? So you can see like, well, what is this premium? 47 times $1.35. Oh, it probably already told me there. So 6,345. So the current one is 11,756. That's your maximum position amount, right? So yeah, so that's the test. And when I ran this, obviously UNH came up, and some interesting things here is that, I mean, this is a new fresh day. I haven't looked at this yet. healthcare, 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 healthcare. There's a lot of healthcare in here. And healthcare is very defensive, quote unquote. It's volatile, but it's very defensive. And that's kind of interesting because volatility at this point was at its lowest. And if volatility starts coming back in and people start getting freaked out, they theoretically roll into the defensive names. Now, they don't necessarily buy defensive. Sometimes it could be a long short equity where they're long the cyclicals and short the defensives, healthcare. And then when volatility comes in to the market, they're losing on their longs, and then the things they're short have to be covered. And so then they rise when you get volatility, right? So I thought that was kind of interesting that healthcare names were popping up. Right, and so then I have UNH, NVO, I also got Newmont. That seemed like a low probability trade. All these are low probability trades, but I thought, hey, I'll pick up a gold miner in case like inflation really comes in. That's fine. But I did get filled on UNH, and then I have GSK, which I think fell out of it. Yes, it did. Let's go back. Yes, so GSK was one of them. And for these entries, you got to be a little bit meticulous and very prudent because you're buying 10 deltas. And that's over here on this wing. You got to be careful with these. The market will give you some quotes. When the market's open, it'll give you some quotes. And if you're not careful, you can actually buy that 10 delta way too high outside the bounds of what you should be. So this requires that maybe you have Claude or something helping you, that if you're going through a chain, you go to the longest, there's a 10 delta right there, right? And it's like, okay, let's say I buy it for 72 cents. Well, the implied volatility is 26.5% because that's what the last price was. That's what it's based on. And so if I go back to the volatility, 365, and do the 26.5 here, I could see that 26.5 implied volatility, that's like right at the median, right? The P10 is 24.1. So it's not bad, but you just don't want to overpay, right? That's what you're trying to do. And so if you came in here and bought this for $1, you're probably screwed, right? So you're trying to not pay a lot of money for low probability trades. And so all of these trades are like $500. It's very small. And the probability, like you saw over 13 years, is a 21% chance. And there was a lot of skip trades and whatnot. But you don't expect a lot of these trades to work, but if they do, they really work. And they help drive a lot of the tail side of the portfolio that a lot of people don't capture, correctly. Because if you're doing like a call spread, well, you're not going to make, here, hold on. You're not going to get some really big tails on a call spread. So if I do CLH, so this is a call spread. I buy this 30, sell the 55. Well, I'm capped in how much money I can make, right? Now, it's probably a higher probability trade, but I'm capped on the right tail. But UNH can go to infinity. NVO can go to infinity. GSK can go to infinity. And that's what you're looking for on these tail trades, right? So I go back, cancel that. Let's go to the back test, click on one of these, and go down to one of these just so we can look. You see these percentages, right? 9,815 on Apple. What is that one? Right? Look at that. You bought it mid 2019. You survived COVID. I went over this last video, and you just held on to it. They're tail trades. You just hold on it till expiration. Doesn't matter what happens. You only spent 0.5% of your money on it. Nobody cares, right? Just whatever it does, it does. And you let them sit in your portfolio And you don't want to allocate all of your portfolio, obviously. You want to spread this with maybe some, maybe spreads are your main portfolio and this one drives the tail. I've done portfolios like that. That works. And yeah, so a lot of stuff going on here. Very nice. Another thing here too is this. AMOA now has live market data. And the live market data, a couple of things here. It's brand new, so there's probably some ugliness on the UI or things a bit buggy. Fine, whatever, right? I'll fix all that stuff. But this shows you the GEX levels, and if you're into live trading or whatever, you can see these levels. So today, we were up here in these levels, and it came down, boom, 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 and it hit that put wall, right? That target of the put wall. And there's so much negative gamma here that in the last 10, 15 minutes, you had this big run up. And I don't know if you guys day trade or something. I wouldn't recommend it, but that's for you guys. Now, it's a bit ugly because I only have 1 day of data, right? Like if I go to Apple, like you're just going to see 1 day of 5-minute bars. Oh, right. There's some bugs. Like, okay, here we go. So it's only like 1 day of data. The tick marks are kind of ugly, but we'll get it all going. We'll get it all fixed. So it's in a lot of positive gamma right now. Okay, another thing too is that the snapshots at the end of the day used to come at around 5:30 p.m. PST. And currently, right now, I'm streaming all the live data that I need. And so the actual snapshot of the day should happen within the hour of the close, somewhere around there. So if it closes at 1 p.m. PST, you should see the snapshot at 2 p.m. PST. So because all the data is already there, I could just snapshot it. So that's all good to go. So snapshots are much quicker and things like that. But this is going to be my work in progress. It's going to be changing. Try not to trade on this stuff because there could be bugs and it's brand new. That's all I'm saying. But it's live though. There's no overnight session or pre-market that cost a ton of money to get, but it's every ticker, and well, every ticker. But I don't know how pretty all the stocks are going to look. Let's see how Netflix fared with earnings. Well, they got smacked. See, that's kind of interesting. Look, you have this call wall. They had earnings and they blew through down this put wall. Well, there's really no there's no spread up here. It's just between these two numbers. You can see even in the morning, like market open, you saw that these tick wicks between there. So that's kind of interesting. You can see these types of things in the market. But as more data comes in, the charts will look a little better. They just look a bit funky because you have 1 day of 5-minute bars, right? And some overnight session stuff. And so maybe if I get rid of not showing overnight session bars, it might be a little bit more prettier. So I'm going to work with it. That's all I'm trying to say. But there is live data now. You just click the live button. And then you go in the past. Now you're in the snapshot view, right? And snapshot view is really good for long-term observations of things. So when you're looking at tail trades, you can run your screener. And right, so what I basically do is I have my watch list, load up the watch list, and I look at my delta, pin chart of the deltas, zoom out a bit, and I could see that there's this spread here, 57.50, 80, which would be nice on earnings. If they have good earnings and it just blows through there, then I make my 23 grand and I'm done. I don't have to do anything. I'll just close the trade. I'll just make some money, right? Okay, and then I tab over sell. I can see, hey, my spread that I'm trading is still there. Looks good to me. Next, Wix. Okay, Wix was a tail spread. It originally was targeting this 70-120. That's still there. Fine, I'll just leave it. And I could see that put wall has been there for a while, and that call wall comes in and it comes out, comes in and it comes out because this one's competing with it. Now this one's competing with it, right? You could see it come down here. See? So that's a tail spread. A tail spread. I think 900% is the max on that one. You don't want to go higher than that. They tend to lose. Newmont, that's a tail trade. You're not really going to see anything on this chart for a tail trade, but you could see that you get a lot of volatility and then the options die. That's kind of the textbook of what you get. You get a pullback, things die. Now, it's not to say you get another leg up. I'm not trying to guarantee anything, but that's typically what happens. NVO, a lot of volatility to the upside and downside. Look at that. And so that's all the volatility, but now it's saying that the options have died in an implied vol. So that's a spread, a tail trade. UNH, same thing. They had earnings today and they did really well, but it reversed. That's okay. We don't look at these things daily. They're so far out into the future. So if you go here, you could just see if I do like daily here. So that's the trade. 650 for like a 1% premium. NVO is $1 for 90. What is that? 10, 1. It's like 1% or something like that. 1.10%. GSK. This one, I wasn't as confident when I put the trade on. I think I overpaid. But who knows, right? So you can see that one's out till January of 28. See that? I mean, it's a long time. And it's 78 cents for the $85, right? That's less than 1%. And Newmont Mining, same thing here. It's till June 27. And so this would, we would have to have another leg up, essentially, in probably inflation or fear trade or whatever. But they're small trades, right? This one is $239, right? Like you're trying to capture the tail, right? You're not expecting these to, have an 80% probability of winning. But once you get them right, they do pay handsomely relative to your entry cost. Okay, and so that's all I have. Still have things on the watch list. The spread stuff, things have fallen out and not come back in again. And I've seen this before. It's very indicative of future volatility. I've seen this all the time where spread trades disappear from the signals and then you get a lot of volatility. So I'm kind of holding off on allocating more money and kind of sitting on the sidelines. I have, let's see. So this is the whole thing right now. So NTNX, PL Open 10 grand. That's probably all the gains so far. But you can see everything's in positive P&L. Even the tail trades are P&L and positive P&L. Sell is positive P&L. Wix is positive. Those are the spread trades. So you can see they're small relative to the portfolio. And then the spreads are just carrying everything else. Now, this one was almost half of 46. I think this is like $5 grand. I can't remember. But remember, I converted that to a call spread. So that's why it says 1,300% because, I don't know, they don't know how to calculate it or something. But pretty good. So far, so good. And it's just building up the portfolio, waiting for the signals, and then putting on the trade. And then eventually you build up a big enough portfolio to where things start falling out. You put one in. And so you're not trying to like get 20 positions on in a day. Like this is taking months and months and months to develop, right? Because you're only trying to wait for high quality trades. You're not trying to force trades. Every time some signal comes up, you're not trying to force it. And so the VIX side of the equation, go to gamma on VIX. Well, we have this 22, which is Wednesday. That's when VIX expires. And there's a 20 there. So if the market, it looks a bit precarious, but can be deceiving. It's kind of in no man's land. So there's a huge gap here, right? Especially if it breaks this 28.5. Then there's this huge gap here down to 28,000, down to 27,000. So it's going to have to start pushing up to kind of like attach itself to this average, just like in the past, right? They write averages in the past. You see them all writing averages. Average, 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 average. So it's got to hold on here or you're going to get a lot of volatility and chop. But that's what I've got, and that was all the updates, and I hope you guys are enjoying AMOA, and if you have any comments or suggestions, you can always email in the support. The live GEX charts are only for Max users. Backtesting I put on Pro and both. The historical GEX only works on the Max plan. So if you're trying, you could try for $10. It's fine. And this is probably one of the lowest cost value propositions on the market right now. And, you know, I'm a practitioner of the site. I'm an engineer. I build it myself. If I see something wrong, I fix it right away. And if I'm missing a tool, I build the tool. So thanks for watching the videos, and we're going to wait for some volatility before we really start putting on some trades. See you guys.